Imagine a database of information, completely transparent to the world, yet armed to the teeth with the highest security. This is, of course, blockchain technology. With the advent of blockchain technology, cryptocurrencies have become a real phenomenon. But that raises the question, what exactly is blockchain and how does it work? In a simpler explanation, blockchain is a distributed database that records data and transactions. Distributed across a network, information is recorded and stored in blocks, all connected by a chain. Once recorded, it becomes resistant to change. More importantly, blockchain helps to facilitate transactions and safeguard the data without a third party. Let's break down the process. Blockchain is decentralized in nature, relying on the nodes to maintain integrity of the data stored on the chain. So when an action is made on the ledger, every node connected to the chain can comb through the information simultaneously, making it extremely difficult to manipulate, effectively preventing bad actors from gaming the system. So with blockchain, we have security, transparency, and accuracy. While blockchain is most commonly used in crypto for data storing, it is also widely used in the banking industry due to its ability to process transactions perennially. What's more, a blockchain can be used to store the code for smart contracts for agreements to be executed without the need for an intermediary. And why stop there? Blockchain could even be used to improve global living standards. Small businesses in developing countries could use blockchain to reach a global audience without having to go through a centralized authority. And the risk of identity fraud can be reduced by storing and maintaining online identities through blockchain technology. Blockchain is revolutionizing how we think about digital assets, and its uses are continuing to evolve. There's no doubt, it's here to stay. Would you pay $69 million for a digital collage of 5,000 images? Or how about this pixel artwork, which sold for $11.8 million? Or perhaps you might prefer buying the world's first tweet at the sweet price tag of $2.9 million. These were sold to buyers as scarce assets in the form of non-fungible tokens, or NFTs. But how does it work? Let's start with the basics. NFTs are tokens that are unique and impossible to replicate. Each NFT contains computerized code and is cryptographically verified to substantiate the ownership of a digital or physical asset, like music, art, licenses, or even real estate. Since they are built on smart contracts via an underlying blockchain protocol like Ethereum, Solana, or Polygon, so the possibilities of distinguishing the provenance of these assets, democratizing the identity management, and fractionalizing the ownership among multiple owners is possible. But what differentiates a fungible and non-fungible token is the underlying digital identity system. Picture this. Fungible tokens like Bitcoin can be substituted for another that is in circulation. NFTs are rare, hard to create, and indivisible, meaning you'd have to purchase and own an NFT in its entirety. But each NFT has specific information that cannot be exchanged like for like. Essentially, fungible tokens are indistinguishable, unlike NFTs. Some of the key reasons why NFTs are attractive are mainly due to its ability to prove the authenticity of an asset, allowing owners to have full control over their data and to monetize their creativity. Still, NFT is relatively new in the digital realm and is not as widely adopted yet as compared to fungible assets like Bitcoin. Building decentralized apps for NFTs also require a lot of time and experience, and the prices of NFTs are certainly not immune to market forces. Sure, you can buy an NFT to resell at a profit, but there's always a possibility of the market deflating. Nevertheless, for many people today, NFTs present an exciting new frontier where the sky's the limit. So, you want to turn $10 into $100,000? With crypto trading, you can. But nothing is perfect, not even the most known cryptocurrency, Bitcoin. And so, many people are turning to invest in the future of altcoins. But what is the hype all about, and how do they work? And are they worth the risk? As more people partake in trading Bitcoin, its value continues to climb, and the high prices can be a barrier of entry to some of us looking to join the crypto scene. Fortunately, it's not the only option. Enter the realm of altcoins. Altcoins are simply a collective term for cryptocurrencies that aren't Bitcoin. These days, the term typically refers to new cryptocurrencies, and the popular ones have a good market cap. People lean towards trading altcoins because they are driving innovation in the crypto space. Each altcoin serves a unique purpose, playing by their own rules to improve on the limitations of the previous generation. Such capabilities include quicker payment processing speeds, lower average transaction fees, and the ability to handle more transactions per second. Altcoins come in various categories, and here are some of the important ones we should know. These are mining-based altcoins, stablecoins, security tokens, and utility tokens. Ultimately, most altcoins are developed with unique mechanisms to offer a wider range of evolution. And the possibilities are endless. But we know the world of cryptocurrencies is volatile, with incredible gains one day and crippling losses the next. Altcoins are no exception. So be wary of pump and dump schemes and fraudulent listings circulating around. Take note that there are not many outlets utilizing altcoins because it still lacks exposure. And do your research when you diversify your portfolio, because not every altcoin out there is worthwhile. Picture this. You're about to make some of your biggest financial decisions. You want a mortgage for your business or to pay off your loans quicker. As you're in line at the bank, you come to realize it's a lot of time, stress, and more money in fees to get this done. So you think to yourself, why don't I do this some other time when the rates are lower? Or when I have more time for this? And this is also when you think to yourself, there has to be an easier way to do this. There is. The easier way is most commonly known as decentralized finance, or DeFi for short. But what is DeFi exactly? How is it different from traditional banking? Before we learn what DeFi is, let's recap the existing financing models that we're used to: central finance, or CeFi for short. CeFi is how conventional finance systems work. They're typically controlled by banks, governments, and shakers of the economy. Then think of the excessive paperwork, long wait times, and the high barriers of entry. These inefficiencies do not exist within a DeFi system. The intermediaries and the middleman fees are replaced with smart contracts, which shortens the process from months of wait time to a few clicks. For most of us, the benefits are significantly lower fees and much shorter wait times. On top of it all, the ultimate goal aims to enable universal access to basic financial instruments, such as a deposit account. We usually access DeFi services through an application built on the blockchain. These applications are decentralized, and we call them dApps. dApps are built on open-sourced peer-to-peer networks that no one single entity controls. These applications are programmed by smart contracts, which allows the system to instantly execute a service as long as the applicant fulfills the criteria. This means no more weeks of waiting for paperwork to go through, no more excessively high barriers of entry to access basic financial products. DeFi empowers everyone with access to various financial applications, regardless of where or who you are in the world. And as DeFi trudges forward and lays the foundations for a financial revolution, financial opportunities are abound, especially for those in search of opportunities for larger returns through lending or borrowing. DeFi presents the open fields of financial liberation for everyone, overcoming the fences set up by traditional financial entities. Want to find out more about the history and future of DeFi? Read more on Bybit Learn today. Imagine a cryptocurrency trading platform not managed by any person, company, or authority, giving you total control over your cryptocurrency, higher security and control than traditional trading platforms. This is the promise of decentralized exchanges, or DEXs. With DEXs, users can trade directly with one another, using smart contracts that connect buyers and sellers without an intermediary. Smart contracts automatically activate when their predetermined conditions are met, and then its transactions are recorded onto the blockchain. where the data remains forever, never to be altered. While both decentralized and centralized exchanges give people access to high-quality financial tools and services, the main difference is in how they are managed. Centralized exchanges are managed by organizations or individual entities who are responsible for protecting their users' personal data and funds, giving them total control over the exchange, from determining its function to charting its development. Decentralized exchanges, however, are not controlled by a single person or organization. Instead, its users typically participate in a democratic decision-making process, granting them control of the exchange through their interactions with the platform. This grants users anonymity, privacy, and security. From custody over your own funds to trustless transactions and cheaper trading fees. However, some DEXs have poor user experiences or slower speeds of transaction, while others may struggle with a lack of liquidity. And because DEXs are controlled by their users, there really isn't any customer support you can turn to when you need help. That said, many people prefer DEXs as they like having better security and complete control over their funds, even if DEXs still have a long way to go before overtaking centralized exchanges in popularity. Whether you're venturing into cryptocurrency investment for the first time, or you're a longtime veteran holding on since day one, market cap is an essential metric to gauge an asset's stability, especially when you need to compare values across cryptocurrencies and understand their overall growth potential. So, what exactly is market cap and why does it matter? Investors analyze an asset's market cap by multiplying the current market price of a token with the number of tokens currently in circulation. It depicts the ebb and flow of the valuation of the crypto industry to help us make a more informed investment decision. For example, the market cap can be differentiated between a total crypto market cap and a fully diluted market cap. Total crypto market cap measures the snapshot of the crypto project in the present, while diluted market cap focuses on estimating the future value of a project, taking the maximum supply of an asset into consideration. Why does this matter? Relying only on data from the total market cap in a volatile environment can be misleading, as data can be manipulated. Plus, considering the maximum supply in a fully diluted market cap can give us a more reliable estimation of whether the asset is under or overvalued. Typically, market cap of crypto assets can be classified into three categories: small, mid, and large cap. Large cap crypto are more established, with a market cap of over $10 billion. They are less risky, with sustainable liquidity that allows investors to cash out at relatively stable prices during extreme volatility, but they have slower growth. Mid-cap coins are generally riskier assets, but they're more rewarding for their untapped potential. Small-cap coins with less than $1 billion market cap are more susceptible to price fluctuations based on market sentiment, lucrative at times but may dwindle into thin air quickly. Analyzing the market cap is one piece of the puzzle that can help us make better informed decisions. The meaning of a cryptocurrency and token are inextricably intertwined. There may be some who believe they're essentially the same thing, but also others who beg to differ. The truth is, they are both forms of digital assets, built differently to serve different purposes. But what sets them apart? A cryptocurrency is built on a native blockchain network and mainly used as a means of payment for products and services or as a store of value. They are decentralized in nature, relying on codes to supervise the crypto issuance and transactions. And cryptos are issued directly by a blockchain protocol through mining, just like Bitcoin. On the other hand, digital tokens are programmable assets built on an existing blockchain. They are usually distributed through initial coin offerings or ICOs, and are often used to unlock certain features on the platform the tokens were designed for. For example, we have governance tokens, like Maker, where decentralization truly matters. Token holders can use these tokens to influence a project's direction, propose changes to a protocol, or vote on new proposals. Then there are security tokens. These are direct on-chain representations of real-world assets like real estate or stocks, but in digital form. Buying a security token gives you the ownership of that asset on the blockchain ledger. And not forgetting utility tokens. These give users access to specific uses of a product or service based on a blockchain. For example, users can use ETH to access dApps, and as a means of payment for smart contracts to be executed on the blockchain. Non-fungible tokens, or NFTs, are yet another kind of token. Each NFT contains computerized code to represent the unique asset, like a piece of digital art. The digital signature makes it impossible to be exchanged for an identical piece. These examples are by no means all tokens that are available out there in the crypto space. And staying up to date with what's new in the market will help you make better investment decisions. Whether you're an investor or trader, you're here to interpret and profit from the financial market. Although technical and fundamental analysis both have their merits, the contentious debate over which to use continues. So, which analytical technique is better? Technical analysis, or TA, is used to forecast the future price movement of an asset. It focuses on an asset's historical information through the study of charts, trading volume, and market sentiment. Such analysis helps identify market patterns and predict an asset's future price trajectories. This data can be evaluated by many factors, and most traders use different combinations of factors. For example, for traders wanting to determine if a trend in a market is about to reverse, momentum indicators like RSI are useful, or using volume indicators like the Chaikin money flow to identify the buying and selling pressure of an asset. But sometimes TA alone is not enough, and advanced traders prefer to use a combination of technical and fundamental analysis. What then is fundamental analysis, or FA? FA emphasizes qualitative factors to help traders gain a holistic view for gauging the asset's value. FA looks into the fundamentals, including the project's utility, the team behind it, and the roadmap that assesses the project's sustainability. For instance, in crypto, understanding the rate of consumer adoption, the strength of community support, or even the project's network activities can help traders assess the longevity of the project, predict its future price movements, and determine if the coin is under or overvalued. Investors tend to rely on FA as an objective indicator, assuming that the market favors the long-term value of the project. So, which is better? Both TA and FA help balance out the unpredictable factors that could dominate the market. And ultimately, each one helps traders and investors identify investment opportunities more holistically and objectively, especially in a volatile market like cryptocurrency.